So rates have been higher for longer. We have these rates that are kind of kicking everybody's butt right now when it comes to commercial real estate, consumer debt, like all of that type of stuff. And so even if the Fed would have been like, we're cutting a quarter point today. Okay, so now your credit card went from 29.99 to 29.74, right? It's not going to make a huge significant impact on anything. But what it could do is it could say, hey, like, we understand that the lag effects are kicking in. Let's slow them down before they break everything.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, we got the news today that inflation is down. How convenient. And if inflation's down, then how far off can rate cuts be? Well, our good friend Eddy Gifford is here to explain. Eddy, it's great to have you back on. So when's the rate cuts coming?
Well, not today. We just found that out. Debt has been coming in. We're starting to notice that it really looks like the lag effects of the higher rates combined with the high inflation is really starting to make things crack, maybe even crumble a little bit. So, if I was Powell, I probably would have cut a quarter point today, but that's not what happened. So, as you mentioned earlier, CPI still slowing, right? Not going down, but still slowing. And we got a beat today where it actually came in lower than expected. So the market was super happy about that. The Fed held rates steady. But then, they basically said that they're only projecting one cut this year. So it's very strange because for a guy like me that talks to Main Street USA every day and sees people that are challenged right now, that doesn't seem to be the picture that they're painting for us.
So, I guess what choice does he have? He figures the election's probably cooked already. Nothing you can do there. So might as well just do what's right for the country or do what's wrong for the country.
Well, I think if we look back throughout history, that the Fed has never got it right. And, generally speaking, what happens is they wait too long to cut. And so by the time they cut, things break and crumble. And the reason they're cutting is because something broke. And, we've been seeing it for a while. We've seen utilities outperforming, although they pulled back a little bit. We've seen gold outperforming. We're starting to see treasuries outperform again. We're starting to see all these like flickering risk off signals. But of course, everybody keeps telling me, no, this time it's different. This time it's different. And then in 2 years, we're going to look back and be like, oh my gosh, all the signs were there. Why didn't anyone do anything? What was going on? So it just feels like we're barking up that same tree that we're always barking up, and the consumer is going to end up being the one who gets hurt by it.
Mm-hmm. Well, do you think that rate cuts are the cure for all that ails us here?
No, because there's already been. I mean, think about it. So rates have been higher for longer. We have these rates that are kind of kicking everybody's butt right now when it comes to commercial real estate, consumer debt, like all of that type of stuff. And so even if the Fed would have been like, we're cutting a quarter point today. Okay, so now your credit card went from 29.99 to 29.74, right? It's not going to make a huge significant impact on anything. But what it could do is it could say, hey, like, we understand that the lag effects are kicking in. Let's slow them down before they break everything. And that's just not what's happening. The problem with being like overly data dependent is you get up in this situation where the data has to show that things are bad or, abysmally bad before you do anything. Well, by the time that happens, it's too late to cut. It's too late to do these things. So I think that they've already waited too long. And obviously the fear is the inflation factor. We're seeing that slow. It's still not, heading down to 2 anytime soon. But, it can get it down to 2 or 1 or 0. would be a deflationary event where everything pops and we see this significant correction in the stock markets. And we're prime. I mean, it's easy to look at it and say, hey, this is a bubble. It feels like a bubble. But how much further can it inflate? Your guess is as good as mine, but when it pops, it's going to be ugly.
Hey, when it pops, it's going to pop, huh? So you're sticking to the thesis: gold, silver, Bitcoin. What about other commodities here?
Yeah, I mean, we're sticking to the adage of rules-based, quantitative type strategies, and making sure that your portfolio is truly diversified. So everyone has like 100 stocks and they think they're diversified. You're not. Every single stock moves in the same direction. Everything is correlated. Like everyone thinks that, I have stocks and bonds. Well, except for inflationary times, bonds tend to correlate with equities. And so you got to have something that maybe has some type of rules base that helps you lean in or lean out of a trend, depending on what the trend is. And you got to have the stuff like the commodities and the precious metals and even the cryptocurrencies now, as they've offered, a uncorrelated return. We don't necessarily want inversely correlated, because all that means is that one side goes up by 10%, the other side goes down by 10%. Well, we just earned zero, right? We want uncorrelated. We want everything to make money over a long-term cycle, but we want it to make money at different times. And that's what a real portfolio looks like. And unfortunately, I don't see many portfolios that look like that nowadays.
Hey, as somebody once told me, the trend is your friend until the end.
Yes, it's one of those things where the market's going to do what it's going to do until it doesn't. And you have to have a rule or some type of exit in place, because especially if you're near retirement, and a lot of people I've been meeting with recently, like they've won the game and yet there's still risk on, and they're skipping over the preservation part of their timeline prior to the distribution stage of their retirement plan. And, it's one of those things where you gotta pay attention to what your own plan is, and you got to make adjustments as necessary. If you only need a 6% rate of return to retire based on your current asset level, why are you taking 10% risk? All it takes is one moment. And if that portfolio gets cut in half, you're working for another 10 years. Now, if that portfolio goes up by another 20%, it probably doesn't change your plan at all. You're still going to live the way you're going to live. But if that portfolio goes down by 50%, your plan just got blown up. And it's interesting to see that people don't think like that, or even just understand or realize the risk that's associated with the sequence of returns as they're looking to, transition into the next stage of their life.
Yeah. So how do you measure risk, by the way? What's the accepted way? And do you have any differing approach to it?
Well, of course, Wall Street will tell you it's standard deviation, but all standard deviation is volatility. And just because something is more volatile, it could be volatile and moving downward, and something that's more volatile could actually be more conservative if the drawdowns are less. So we pay very, very close attention to portfolio max drawdown, and then we're looking more at Sortino than Sharp, because I've never had a client mad at me for volatility to the upside. Volatility, it's so crazy, I accidentally made 30%. Like, they're not mad at me about that. Obviously volatility to this downside, that's the thing that people are concerned about. And so max drawdown and Sortino helps us identify, hey, is this a good portfolio, and can this work to our advantage? Sharp is nice, but Sharp stuff takes into account that downside volatility, it takes into account that upside volatility, and we like upside volatility. I don't know anyone who doesn't like upside volatility. We don't like the downsides.
Sometimes you got to take the good with the bad, though, right?
Well, I mean, that just depends on your rule set and whether or not you have an actual diversified portfolio. Wall Street would tell you, yes, if you want to get above average returns, you got to take above average risk. I would say the trend is your friend. Lean in when it's good and have exits in place. And when the trend is down, don't ride the roller coaster down to the bottom. There's other stuff that does well in that scenario, and your rule set should be able to find, or your quant should be able to find where the opportunities are in that situation.
All right. So when we talk again next month, Eddie, you think we'll be looking at a rate cut?
It would surprise me if we don't see a rate cut in July. I would have said that a rate cut today is justified. I don't think they do anything in September, mainly just because they don't want to mess anything up from an election standpoint. If it were me, based on what the data I'm seeing so far, if it continues in the same trajectory, I would probably recommend cuts like at every meeting for the rest of the year. But the Fed's not me, and they're looking at what they're looking at, and I think that they're too late to the party. I just hope that the bubble's not so big that when it bursts, there's too much blood in the streets.
Too much is you would basically need boots to pretty much wade through it all, right?
Boots. I don't know. As much we've had 15 years of 0% interest rates. I might even argue you might need a boat with a paddle because it could get real bad.
Gonna need a bigger boat, huh?
Yes.
That's a little scary.
I hope I'm wrong, Kerry, but there's a lot of stuff there. The bigger the bubble gets, the worse it is when it pops. So there are ways to make monies off those scenarios, but it's not buy and hold, that's for sure.
All right. Well, Eddy, appreciate you coming on. Just tell us how we connect with you these days, best place to find you and all.
Yeah, easiest thing to do, go to tactivewealth.com/Eddy-Gifford. That's Eddy with a Y, Gifford. Or go into that old friendly Google, type in Eddy Gifford, Eddy with a Y, Gifford, and they'll probably see this interview on there tomorrow.
All right.
And a bunch of other stuff too. So, we're here to help. Right? It's a trying time, and there's a lot of people concerned, and that's what we're here for.
That's what we like to hear, Eddy. Appreciate you coming on. Hey, got a question, comment for Eddy, myself? Shoot me an email, kl@kerrylutz.com. A link to Eddy's site will be found in the show notes to this interview on financialsurvivalnetwork.com. While you're there, please subscribe to our newsletter. Eddy, always a pleasure. We'll talk to you again real soon.
Thanks again, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.